Ladies and gentlemen, welcome to the Sofi Weekly Podcast. It's been a volatile week. A lot of stuff has happened, a lot of interviews. Kramer, famous Gary Gordon, lots of fun stuff. First off, Roy, haven't talked to you in a week. How you doing?
Good, yeah. It feels like 2 weeks for some reason. I've been looking
Yeah,
forward to this.
yeah, me too. Tevis, how you doing?
Good.
Yeah,
Good.
that's good.
You guys survived the blizzard, so that's always good.
Dude. So it was like 20 degrees over here 2 weeks ago. I think it hit like 18, 19. Sunny day, summer, amazing. Blizzard. It's like full
Seriously.
snow outside. It's honestly, I don't understand this country.
It was winter and I was driving with two windows down, and now it's like you need everything. You all bundled up again.
Not driving with two windows down now?
No. Heated seats, windows up, driving like this. But yeah. Tevis, what do you want to start with first? It's been a busy week.
Let's see. So we can save the Notto on Mad Money stuff. Here, I'll post a list in the private chat of the topics. We can start with the Galileo stuff if you want. Sofi's ranking on the top 100 bank. Jeremy Rischel selling more stock. Notto on Mad Money. Short interest at all-time highs again. And then Notto hinting a tax product. So those are the topics that I have. We can do whatever order we want.
Let's talk about the Galileo product. So Galileo unveiled a new product this week called Buy Now, Pay Later Post-Purchase. What did you guys think? Is allowing to consolidate purchases that you've already made into short-term loans? Not that this is being offered at SoFi, but this is being offered to the Galileo customers. Do you think that this is going to be a product that's in demand?
It might. I think that there are. So Buy Now, Pay Later grew rapidly. I don't remember the exact statistics, but I remember looking at it closely just because I'm a PayPal investor. That's one of the reasons why Affirm spiked the way it did. And everywhere I went, at least down here in Houston area, Buy Now, Pay Later was offered everywhere. Like Klarna just really went for it. And the theory that a lot of macro economists had was that this was due to not some sort of innovation, but the fact that you can apply and get Buy Now, Pay Later very easily, even if you're over leveraged with debt. And so it's just another lever that people could push to be able to meet that holiday greed, which maybe they couldn't really afford. And so there's probably some folks that are over leveraged. We won't know that for a little while. I know that there's a lot of services that are like the Pay in 4 that PayPal has, that you just make those 4 monthly payments and you're done. But there's a lot that offer longer terms as well. And so if quite a few people overdid it over the holiday season, like this is basically the perfect time to launch is what I'm saying. Because those payments, people might be thinking, oh man, I have more money coming late in the later half of the year for whatever reason, but just I need to spread out these payments, make them smaller, even if it costs me more in the long term. And people are willing to do that. I don't know that it's going to be more than a niche product, but it could grow into something more. We'll have to see. But I don't think that there's going to be zero demand. I think it's the perfect timing for this.
Yeah, I think about a lot like Dave, one of our customers, which that stock is exploding. I don't know if you guys follow that company.
Yeah. Did you see that with Ram and Dave and the pushback there on Twitter?
I saw that he was talking about, Dave over SoFi. I haven't seen anything recently. I actually haven't seen him tweet in a while.
It was great because he was pumping Dave and not knowing that Dave uses Galileo at all. And it's like, hey, look how great Dave is. SoFi is trash, his whole thing. Paraphrase, of course. And then I believe it was Chris Hager, Data-Driven Investing, that came in and was like, you do know that they are a SoFi customer.
Sure. Yeah. Okay.
It's just like, oh, okay. Like, what can you say? It was great. So yeah, check that out. It was hilarious.
Yeah, I'm just looking at the chart right now. Like this stock was for Dave was um back in November was $5 or so. Today it's at like 40. So just absolutely exploded. Galileo customer, by the way. So that is still good. Um, but one of the products that they offer is cash advances. It's one of their biggest products. And I think that you may see them roll out buy now, pay later post purchase because they are really, really into these very small, dollar amount loans. Devis?
Yeah, I mean, I'm still hung up on the fact that there's an entire product called Dave. Like
Entire
it's so,
company.
yeah, it's so confusing. Like when you guys talk about this, like, oh, on Twitter, I feel like I'm having a stroke, man, because I'm like trying to keep up.
You've never heard of them?
No, I have, but I forget about. Yeah, it looks as stupid as it sounds.
Yeah. But they make SoFi money. So
This is their big product. This is where they make all their money. So it'd fit right into the sort of small dollar cash advance. You're not going after high income earners. You're going after, just regular spenders, nothing crazy. And look at Galileo's chip right here.
Share my screen real quick.
Sure. Also, wait, can I just point this out? Is this chip supposed to look like a bear face?
Wow. That's good branding.
That's innovation right there.
That's innovation.
Good tech, baby.
Only seen at Galileo.
So
yeah, just why own SoFi when you can own Dave? Compare the metrics. Dumping on SoFi again. Yeah. And other people were quick to tell, like, hey, so they run on SoFi's tech platform. So just all over it. And of course, data-driven investing retweeted it. Do you also know who's so awesome? Good job, guys.
Hey, I mean, in the short term, I would have rather have been a Dave investor. But if you look in their investor relations, it's not something that I think is as comfortable or as linear as the growth that you're seeing at SoFi. And so I think that, things will change, but short term, things can be very, very irrational.
I'm going to clip that and take it out of context and just post it about you.
There you go.
I'd rather be a Dave investor.
There you go.
So Bear has spoken, just all caps.
I've given my
your face and just like exposed on the thumbnail. I'm doing it.
Did you guys see the conversation of mine with Gary Gordon's, the second one?
Yeah, I saw it.
Yeah.
You want to jump straight into that? I thought we were still on Galileo stuff.
Okay, well, you can talk about it, but it was just one product.
We talked more about Dave than about the Galileo thing.
Okay, go ahead. Sorry, my bad.
I mean, I don't know. Like, it just seems like Galileo is putting a big bet. So a couple points. Number one, it seems like Galileo is putting more of their product innovation, product roadmap behind buy now, pay later. They even mentioned in that press release that buy now, pay later is forecasted to surpass 900 million global users by 2027. That's in 3 years. And so there's big bets behind buy now, pay later. I think they had a list of benefits in their press release, and the first one was market differentiation, and the second one was an entry point into lending for fintechs specifically. And I mentioned when I saw this news that it just further deepens the moat for Galileo. It makes their consolidated offering way more unique for these financial institutions, and it widens the net of potential targets that they can go after because it's an entry point into that lending offering specifically.
Have you seen many Galileo customers rolling out buy now, pay later since the first announcement?
No, which is what makes me surprised that they're like, I think this is like the third or the fourth product announcement around buy now, pay later since they launched the buy now, pay later offering in the first place, like back in the fall. And so really interesting. The other thing, I wanted to mention is I found myself, and we can talk about the Jeremy Rischel cells, but I feel like, because I do weekly SoFi recaps, and I feel like I talk about Galileo product announcements like on a weekly basis, if not definitely on a bi-weekly basis, like every other week. And I just feel as though the pace of technology and product releases far out surpasses the pace that SoFi releases new technology,
Mm.
new developments. Like SoFi, I feels like we've been waiting on Zelle for like 3 years. It feels like we've been waiting on, the Invest app for quite a while. The UI feels like we've
Level
been waiting
one.
on level one options for so
Yeah.
long. And it's like, meanwhile, Galileo and David Foyer, their chief product officer, they're just rolling out Galileo stuff every week, every 2 weeks. And so the reason why that thought came into my mind to compare the two is because of Jeremy Rischel, who keeps selling stock every 3 months, every chance he gets. And I know that people sell for many different reasons. I understand that. It's just interesting to contrast those two leads on the tech side of the business, because at the end of the day, it's one company culture, right? One company sort of umbrella, one vision, one direction. And meanwhile, you have one division, Galileo, which is operating at a much, much quicker speed from a releases perspective than what SoFi is. And it's nice to see from one hand, but on the other hand, SoFi needs to get, like, the core SoFi offering, the B2C offering, needs to get their ass in gear and roll out some more stuff on the tech platform side of things. Because for as long as they don't, users are going to be pissed off, and it's going to be more of a spotlight put on people like Jeremy Rischel and the entire tech platform, and even Anthony Notto himself.
Mm. Yeah.
Can you
Yeah.
throw up my picture, my slide there? I put this out. So UK launch for Robinhood. They don't have options yet. And on the same day, the CTO sold more. And I agree with Tevis. I think innovation and implementation is slow, lacking, not done very well under SoFi. Like Galileo is great. Technisys, that's harder to get a gauge on, but it seems like it's fine. I don't think he's doing a good job at all. And I'm not mad at him about selling stock. And so I threw this poll at him like, hey, it's the same day. It's kind of related. Which happens first? SoFi actually gets level one options finally, which literally they've lost customers on the Invest platform. Data driven investing was one of those where they're like, hey, I just can't. I need the level one options. I don't know when they're coming. Supposedly they're coming. Or will Robinhood launch options in the UK, which, by the way, there's like 2 companies that have level one options in the UK. It's very hard to do. It's very hard to get. And I would think, it should be a very simple thing for SoFi to do this. The poll says otherwise. Robinhood, 54%. I know part of that is sentiment. People are upset the stock is down and the guy is selling. But I think that there's an honest chance that Robinhood launches level one options in the UK before SoFi does here in the United States. And that's not acceptable. Jeremy Rischel, he needs to just leave. He does this every 4 years. And I was looking at his, resume, and I have a few different pieces where you could see, like, internally what people were commenting on him, and going on the blind was one of those that was pretty interesting just to see people's opinion when he was at Splunk.
Yeah.
He was not known as an innovator. He was not well liked, and that's kind of the reputation he had with several companies. I don't think he's bad. I just don't think he's great, and they could do better. And with what you said, as far as Galileo doing well, some pushback that I had when I was kind of saying, hey, maybe he should go, is who would they hire? Derek White. He's in charge of Galileo. He's a CEO right there. Galileo is doing well. I can never remember the guy that's the CEO of Technisys, but he was another option. Like he's actually, yeah, he seems valuable as well. Yeah. So either one of these guys, get rid of this guy. Just say, hey, you've served your time. Great. Take your stock and go, and bring in somebody else.
Yeah.
Yeah. I don't really have an opinion on it. He might end up leaving. Who knows? It's hard to see why there's certain names for certain executive positions, and I don't really fault him for selling. I think some information came out about Jeremy recently, and yeah, I don't know. It might need to be a change of executive team, but
so it could 100% be, and I know we've sort of like dovetailed into that news. So Jeremy Rischel sold 56,000 shares this week This was in addition to the sales last week, which was for tax reasons. He just sold more, and he was like the only executive that sold more. I have the Form 4 up here, so I can just throw that up on the screen.
Sure.
And basically, the thing that I wanted to note is, yeah, absolutely, executives will sell for a variety of different reasons. But what you'll see here is, 56,000 shares at $6.93. He only has about 390,000 shares left. And so I mean, I know they get more shares every year as like when they vest, but he's definitely burning through his total share count because he sells every couple of months, every 3 months or so. He sells. I have the cells over here. And so here you can see just how frequently he's been selling. He sold, this month, and then exactly 3 months ago, and December 21st, he sold. And then 3 months before that, he sold. And 4 months before that, and then 2 months before that. So every quarter, this guy is dropping shares regardless of what the price is. He sold at $5.47, and he sold as high as $9.78. But it doesn't really matter. Like, he's selling about, anywhere between 500,000 to 1 million per quarter. And so, yeah, there could be personal reasons why he's selling, but all I wanted to highlight is that he's not really leaving too many shares left in his name. I mean, 390,000 shares, he's definitely selling quite a bit. Even when he went down to 100,000, like I said, they get granted more. So right now he has 390,000. Like, even then, like he just unloads huge amounts. He sold 200,000 shares back here in 2023 in May. So anyways, that's all I wanted to say. Like, he sold 13% of his stake. I'm sure he's going to get more shares as a result of being a chief technology officer, but every quarter to be selling 50,000 share blocks. And, you contrast that with somebody like Notto or, somebody like LaPointe, even they're buying 50,000 share blocks every quarter. And so you see all of these sales here. This was all for tax reasons. But Jeremy Rischel was really the only one that sold in addition to that. So,
yeah, I don't really care, if they sell or not. Like, you never know what's going on. I'm hoping that it's like Webster when he was leaving, or when SoFi basically demoted him, put someone else in his position. He started selling aggressively, and that's fine. I mean, you don't have to hold on to the shares, and so sometimes that can indicate that you're leaving. So if that's the case, God bless him. I hope he sells all of his shares and he is gone. My issue with him is I just think that the actual product itself, the SoFi platform, is not living up to the quality that you need to have. And, it could be that there's somebody else that's an issue, but if you're the CTO, the buck stops with you. And so I know Galileo is doing well with Derek White. I think that he's pretty incredible. It's just an easy replacement in my mind. So,
well, I think you hit the nail on the head, Roy, because this is exactly what I was saying. It's because people see the tech aspect of SoFi as lagging, and they have for several years, that they now put a heavier scrutiny on Jeremy Rischel selling. Like, nobody's saying anything about Lauren Stafford Webb selling, because the marketing for SoFi, the PR, all of that initiative, the comms, they're all on point, right? All of their Face of Finance campaign, the SoFi money moves, like SoFi Stadium, all of these things are all on point. And so we understand, I think, as a retail investor community, that people sell for all kinds of reasons, but it's because it's compounded by the fact that that side of SoFi's business is seen by large part as a weak point, that people are like, oh, let's put two and two together here.
Yeah. No, I think whenever you're talking about one specific person, things happen in people's lives. Who knows what's going on? If he's going to be around for a while, not sure. It doesn't really bother me. Like I want to see the actual financials of the company. And if the innovation slowing on the tech side is going to be meaningful, like there are serious gaps between us and our competitors, then we're going to see that pop up in, new member growth or organic member growth, something like that. We'll have to see. If you monitor a Robinhood versus SoFi from a customer satisfaction standpoint, not just on the product standpoint, it's very heavily favored in SoFi side. So, people can say one thing about the product and another way whenever you're trying to look up that product. People seem more satisfied at SoFi, which could lead to more organic growth. Who knows?
By the way, I am now a SoFi member. Just relay, but I'm working that way towards becoming a bank customer this year. So,
Working your way. Why can't you do this tomorrow?
So I'm in the interviewing for a new job, and it may be a couple months before that comes. And it's easiest to switch when that happens, just with the direct deposit stuff. If not, then we'll just do it. So,
well, you want to switch before you get a new job, so then whenever they ask you for banking information, you can just hand them your new one.
Absolutely. And I had lunch with a friend, or dinner with a friend, and he's sitting on I can't remember what bank he's with, but he's getting like 1% something interest, and he has this lump sum of cash that he's holding for a land purchase. I'm like, dude, why don't you put that money, like, you're a Robinhood customer already, just put that cash there, or even better, SoFi. And so I pitched him on SoFi. And so I'm like, I need to get a SoFi bank account just so I can get some of these sweet referrals. So, because he's not the first person I've done that with. I'm like, I just need to become the customer. I've been waiting. It's about time. That would be a good short at that point. Like, the thesis of the company for the shorts would have grown if I'm the CTO. That's not good.
I want to read this comment out by Anthony Walker. He says, Notto needs to get out of his la la land and react. Like, I think people look so much into small reactions in the market and stuff. Like, what do you want him to do? He came out being extremely aggressive with their 2026 targets, and people are just not believing him. So he's just going to have to show it in the numbers. So yeah. Let's talk about the Gary Gordon interview a little bit, if you guys want to, because there were some parts that people thought that were interesting that Gary brought up. There were parts that people really dismissed. What did you guys think of some of his fair points, and how does it change your opinion of SoFi?
It doesn't.
Yeah, no. There was not much. So I watched the first third, full disclaimer, and I'm like, I didn't get mad. I'm just like, this guy's saying the exact same thing. He said he looked more on the company, and he brought up, there were 1 or 2 points, and I don't remember them offhand, and you might have to remind me, that were a little bit different. Like, he actually looked at Q4 numbers for a change, which is just mind blowing that you could be so against a company where you're just like, but you're not even looking at the numbers. He still doesn't have a good handle on the tech platform. His arguments it seemed like they were very limited. And then it was just incredible that, looking at the value of SoFi right now and the way they're executing, where he's gone from kind of neutral bearish to the point where he's like, hey, I think this would be an incredible short at, I don't know when the interview was done, but like low $7. Come on.
I don't think he even said short once. I mean, Tanner, you can keep me honest, but I think that was just in your title. He didn't really actually say it.
No, he said that off camera. He said that he was leaning more towards shorting it, but needs to know more about the company. And because he doesn't fully understand the tech platform, he's not ready to short it. But he has shorted growth stocks before. He's been shorting Tesla for a while.
And Redfin, I get it. Yeah, he talked about those. Which are very different business models, which you highlighted. Look, I think we've mentioned the Gary Gordon thing on live stream earlier this week as well. So I won't spend too much time on it. Only to say that I know you said last time earlier this week that, hey, you're here to just sort of report and get other viewpoints and not really be combative towards their viewpoints. I still think you were fairly soft, because the tone in those articles is very, very forward, very confrontational, very direct, very curt. But the tone in the interview is him backtracking. Is him saying, oh, well, actually, I don't have a position. Oh, well, when I invested in a bank in the 1980s, this happened. And, oh, if actually unemployment reaches 5%, oh, if we go through a deep recession, oh, oh, their financials are on this page and Citibank reports them on this other page. And it was hard for me to find them. And it's just like, dude, these are all bullshit reasons. And these are all like what if scenarios that it's going to affect the entire macro as a whole, the entire banking industry, as a blanket. And then you ask him, oh, did you look at the tech platform? He's like, oh, no, not yet. I didn't even look at that. And did you look at financial services that are growing 75%? Oh, yeah, but defaults. And I'm like, dude, they're the same recycled arguments that don't hold up. And yet still these articles come out that say sell or $4 price target, $5 price target. And I just think that that's the opportunity to actually hammer home those points, because it seems as though Gary, and I don't know Gary, and I'm sure he's a great guy, but it seems as though it sounded like he had a real chip on his shoulder with regards to growth stocks because of what happened with Open Door and Redfin. And, 2021, all of these things got super pumped up, and he's using traditional, book value to compare SoFi and really discounting the growth and really discounting everything that management is saying. If management says, oh, we're actually going to, come at higher targets than Wall Street, we know that it's going to be even higher than that. Anthony Notto in his Kramer interview dropped 60 million now as a new number. Meanwhile, we were looking at 40 million before. Meanwhile, in January, we didn't even have 40 to 60 million. Like, there's every new month, there's new information that comes to light that suggests, if you read between the lines, if you take the 2 extra seconds it takes to put 2 and 2 together, you'll notice that these guys are going to blow through all analyst estimations. They're going to blow through their own guidance. And Gary does not account a shred of confidence to what management is saying. He's saying that future results, may differ greatly from past results, even though management has never given us a single shred of doubt in breaking their promises in the past. And so I just think that he's looking at everything from a very pessimistic lens, and that worldview is framed by his historical context of what a bank looked like in the 90s and what the tech bubble looked like in 2000 and what Open Door did 2 years ago. And I'm like, none of that shit is relevant when you look at SoFi as a whole and actually look beneath the hood of how this company is actually executing, holistically speaking, and what that bull case is extrapolated when you layer in stuff like the tech platform and when you layer in stuff like, a tax product, or when they bring insurance in house, or when they actually grow financial services to the point where they're actually viable and not just in reinvestment mode. And so I think he's looking at all of the negatives, even though there's many holes in those negatives. And then he's saying we should judge SoFi by the metrics that we judge JP Morgan. And then he's saying, oh, I'm actually assigning $0 value to the exact reason why all of these growth investors are investing in SoFi, because he's assigning $0 value to the growth. He's saying that, they had 1 quarter of profitability. I don't know if they're ever going to be a next one. And you're like, dude, are you even on this planet? Like, are we, looking at the same company? So anyways, that's what I think of the Gary Gordon interview.
Go ahead, Roy.
No, that was shocking when he said that. I'm like, how can you look at the level of execution, their guidance, and what they've done? It wasn't just a one-time fluke that they're profitable. You have to see something pretty insane in the macro, and then it's not just a SoFi issue for them not to be profitable. Period. He mentioned, at least Tevis mentioned, or one of you guys mentioned that he was shorting Tesla for a while. A lot of times value investors, and it's fine to have different ways of looking at investments. There's no this is the one right way. But a lot of times they get focused on, just this certain thing. So with Tesla, a lot of the people that have been shorting it, and to be fair, they've probably done well.
Just real quick, that's actually what I got whenever I opened my first bank account. They gave me a toaster. Sorry, go ahead.
Things have changed so much, but I'm sure that the main reason why he's shorting Tesla is just as far as the valuation, it's high, and it's just a car company, which we know, this is not Tesla Weekly. It's not just a car company. Most of the revenues come from that. And so if you ignore completely what Tesla actually is and say it's just a car company, yeah, it's ridiculously overvalued. SoFi is the same thing. That if you're looking at SoFi and you're like, hey, this is just a bank. If you look at their tangible book value, they're a bit, not even that much, but a bit overvalued. Maybe not even right now. I haven't looked in the last couple of weeks because I smashed down. Uh, but you're ignoring 2/3 of the business. That's absolutely ridiculous. The way that that, and he liked to tout just like every 5 minutes. Well, I've been in the business for like 85 million years, and I've done these things before. And I'm sure he has, and I'm sure he's an expert in the field. But the way these businesses have grown, and this is not a bank with an overhead, by the way, like other traditional banks, is dramatically different than 20 years ago. You cannot use, or you can if you want to, but you shouldn't probably use the same principles you're using to judge banks 20 years ago versus now. A significant amount change in 2008, a significant amount change under COVID. You're behind.
Yeah, I mean, it's one of those things during the interview because whenever you're talking with him and you go, okay, well, what do you assign for the growth? And then he says nothing. I'm not going to go on about something that he doesn't have an opinion on. So I'm there to collect his opinions. And so people got all mad saying like, why didn't you attack him? It's like, if you attack the people that you're bringing onto the channel, they don't come back. You know what I mean? Other people will not want to do an interview. And my job is not to sell Gary on SoFi. My job is to make sure that the investments that I'm holding are
No. Hold on. There's like a country mile in between selling Gary on SoFi and keeping the conversation factual and honest.
yeah, but the
You can come on next quarter when SoFi does report profitability for the second time in a row, and you will say, "Hey, Gary, it's 2 in a row now. Do you think they're going to hit 3?" And he's going to be like, "I don't know, probably not, maybe." And like he can make that argument in perpetuity until SoFi reaches a top 10 bank valuation. He's going to be like, "Well, actually, it's still overvalued compared to Wells Fargo." And meanwhile, Wells Fargo could be like underwater. And so
yeah, but
that's
but
you
I
gotta keep it like intellectually honest. You're not like selling SoFi to Gary.
yeah, but eventually there's going to be one winner. So regardless of if he holds a sell rating on Seeking Alpha between the time that are here or a top 10 bank, that like there's going to be evidence that one is right and the other one's not.
I understand, but there's some poor schmuck out there that is reading the latest Gary Gordon article and is selling SoFi as a result of it when that article is based on a false premise. And so that's why it's like if you're interviewing him and you do know that it's a false premise, it's your sort of moral obligation to call that out and to make that known
Yeah,
because
but then the conversation changes between why do you dislike SoFi, and then it just goes to a conversation of this is why growth is better than value and value is better than growth.
not
I
necessarily. Like if you wanted to not be confrontational with Gary at all, you could have literally not had him on and just read his Seeking Alpha article word for word, because that's exactly the same argument that he provided. But the point of
No, I
having
mean,
open dialogue is to present some facts that he's maybe overlooking.
and I mean, I did. he just at some points didn't agree, but that's fine. Like I'm not there to change his mind. Um, like one of the things that he said was, the checking and savings account is not a profitable business. I said, well, it is, and he goes, well, I can't see it, but he's looking full year, and I'm looking on a quarterly basis and annualizing it. Um, and so, you know, how am I
that's
going to change his mind? I,
that's
I,
the
I,
craziest thing. The annualization is like what makes a year. It's a year. We judge things in a year versus a
yep.
quarter, the right measure. Like that would have been something that I would have pushed back on. And I think that you actually did. I did watch all of your follow up video.
Yeah,
So
I did say that. What makes a year a year?
yeah.
Like why does it
But
have to be that metric?
with some of these points, I know that you weren't looking to make an argument with them, and there's a way to attack the argument versus the person. And I think that you're very much trying to do that. But a lot of those points that you made in the follow up video, I'm like, I wish that you held his feet a little bit more to the fire and like, well, no, like, why do you really think this? Or do you realistically think that? And then, and you did that a little bit, but it just, um, if you're going to have him on, again, I would just encourage you to push those arguments, one or two steps further. Maybe it's a little uncomfortable for him. He should be a little bit uncomfortable. I'm not saying being mean or attack the guy, personally, but it was very clear to me what he was doing, where he was cherry picking data to support his argument. And when he was looking at quarter four, he was not looking at quarter four holistically as a company. He was like, what can actually support my argument? Confirmation bias.
Agree.
It just, I don't know. I would have held his feet to the fire on that.
But I did say that though. I said you're going through and cherry picking all these tiny points that are negatives, while disregarding the 90% that's extremely positive. And then I also refrained by saying there's always going to be risk to a company. Just pointing that out without the opposite doesn't show you the full picture.
And I think it's fine. It's your channel. You can absolutely do what you want. I don't have a channel, so it's a little different. But just as far as a way to kind of show what I'm saying, I had this conversation very briefly with somebody on Palantir this week, and they were talking about that it was just a consulting firm with people in a business. It's not a SaaS. It's not scalable. And I basically pushed back and I said, well, no, this isn't. You don't know what Palantir does. You're mistaken here. And so the guy actually said, hey, do you work at Palantir? I'm like, no, I don't. And then so he asked, how much actual research have you put into this? And then he said something about insider selling. And I'm like, okay, he's shifting goalposts now, where, if he actually wanted to know the business, he would not be asking about insider selling, because he had a fundamental misunderstanding of what the company actually did. And so at that point, I'm old enough now. If I was younger me, I would have just, hey, let's roll with that and let's correct your ignorance. Some people do not want to listen at all. It's just in one ear and out the other. Yeah. I don't know Gary for sure, but he seemed like one of those types where he has his argument. He's going to be obdurate to the point of just extremity, where he just is listening to you or appearing to, but actually not taking anything in, not actually considering anything at all. When you would bring up a point, he would just immediately discard it. Personally, what I've learned to do is just walk away. And so this gentleman with Palantir, I was like, hey, I'm not sure what insider selling has to do with this. I'll just bid you a good day.
Dude, the thing is, there's a ton of people out there that they care much more about being right and winning the debate than they do about actually learning and understanding a nuanced viewpoint that they might not share.
Yeah, but that's the thing. I'm not there to convince him. I want to be convinced, and I wasn't. That's
why'd you have him on?
So I can hear his viewpoint.
But you can read a Seeking Alpha article to hear his viewpoint.
I know, but then he might not be answering the questions that I have. So I want to say, hey, does this also account for this, and this?
Sure.
Yes, it does. No, it doesn't. Okay, well, I learned more, right? Why does anyone do an interview?
Did they get answered?
Well, I mean, a good enough answer where I understand where he's coming from more, but not to the point where it's changed my perspective on the company. So I take it in and go, wow, this is the bear case. I'm not convinced. I think that credit risk, 100% what he said, is the biggest problem with SoFi. We have a ton of risk, but that is banking. That's the lending side of this company. And he can say that the underwriters, he doesn't see the secret sauce, but that goes in both directions. What makes them a weak underwriter? What makes them a great underwriter? So far, they've been great. I'm going to lean towards what they've done historically. Look, but I don't need to convince him on that.
Maybe I can dovetail this conversation into our next topic.
Dex says, Tanner, you're supposed to maintain the echo chamber. You know that. So.
No, but I think a better conversation would be if you go from the bullish side to the middle, and if Gary goes from the bearish side to the middle, and then you have common ground and you find things that you can both agree on.
Yeah.
Very simply, hey, are we seeing the same chart? Is the revenue doubling while expenses are only going up 10%? Do you also see that? Yes. Great.
The problem with these problem with these bank guys, you cannot I know what language they speak, and they do not speak members, products, anything. It means nothing to them. And it's also why whenever you're looking at JP Morgan, Citigroup, Wells Fargo, go on their investor, because that was another thing that Gary said, that whenever he sees a company hyping up that is like a red flag. It's like, no, so like every company's job is to hype up the good things that they've been doing. Some have a lot to hype up and some don't. And there's a reason why JP Morgan and Wells Fargo and all these companies do not talk about their cross-selling or their member counts, is because they're probably extremely stagnant.
Yeah, they're shit.
It's like Robinhood showing their total cumulative or even their monthly actives. That was going down for the longest time, to the point where they said, we're going to stop showing this number off just because it doesn't look good anymore. That's them hyping,
Right. So just to dovetail this, the reason why I'm sort of being a little bit more scrutinous over the second Gary Gordon interview than the first is because we saw from Ortex this week that short interest is likely going to come in at another record, 173 million shares sold short, about 20% of the float. What is going on here, guys? Like, short interest seems to be increasing every 2 weeks, and yet we're releasing news around the company that is still executing, and we're driving towards first quarter profitability. We're going to talk about the Mad Money interview as well, but 40 to 60 million in savings to the bottom line from interest that they would have otherwise paid on preferred shares. And yet, despite all that, shorts keep piling on to the stock. And so what pisses me off is analysts like the Compass Point guy, $4, and then even all the way down to the little insects, the Gary Gordon Seeking Alpha articles that might influence a total of let's say 10 people, 20 people. The entire gambit of those analysts who, even after Notto finished his Mad Money interview with Kramer, like later that night, Compass Point released their we maintain a $4 price target. Like, the reason why it matters is because short interest is so high. And I'm just, again, I know Steve used to say this all the time, like, what are we missing? And it just doesn't seem to me like, from the more I see Gary Gordon on your channel, I don't think that we're missing anything. It's like, what are they missing?
Well, so I honestly think that from a shorts perspective, I've been trying to think about it. And whenever it comes to AMC, GameStop, these sorts of plays, I completely understand it. Now, I apologize to the retail audience that potentially got entangled in that. I wasn't a part of that because I never agreed with the companies. Like, I don't try to play trades. I try to find companies that are going to grow. And I actually have a chart I want to show off after this conversation. But what I was going to say is there a time that you guys can remember where shorts have won in trading a company down that is a pretty strong grower? Like, I mean, they tried to do that with Palantir. It went down the short term, and now shorts are getting destroyed because they continuously put out beats. Then Tesla, they tried doing that for the longest time in 2019, early 2020. Shorts got absolutely crushed because of those continuous beats. Where do we see like this quote unquote shorts winning? Like, even if short percent gets to 50% and we continue to follow this company and see that, some of the trends are not turning around, they continue to go positive, there has to be an influx to try to, crush those shorts. Am I wrong in thinking that?
If they continue executing, then it's just a matter of time before they cover.
Right.
And quite a few probably made quite a bit of money. Congratulations. I'm at the point where, so shorting does hurt a company, especially if they need to raise capital. If SoFi was not heavily shorted coming in to the senior convertible notes, they would have had a better deal. But reality is what happened, and of course, shorts, I think, probably doubled down. They're like, hey, this is an opportunity. I would actually, at this point, the company is so low as far as the share price. From what my perspective is, I would love it if shorts spiked to 30%, 40%. I mean, realistically, it gets harder and harder to push a stock down that shouldn't be down. And it's the same way on the other end, that if a stock is pumping and it shouldn't be pumping that much, it gets harder and harder to do that, no matter who is buying. And so it's a matter of time. They have to execute. my one thought with this, there's like little bear arguments here and there, but at a certain point, it just stops making sense. My main idea is that the stock itself and the company itself should be the same thing, but they're really not. And I think that the narrative of how much interest rates impact SoFi negatively if they don't lower or if they raise for the stock is much more pronounced than the actual company. We know they have a diversified portfolio. They've
We
already
follow a
weathered.
basket.
Yeah. And so SoFi, the company, is resilient. They're fine. It's better for them if the interest rates are lowered, but it's not going to kill them if it's raised. It's not even going to have them miss gap profitability versus the stock itself. It behaves anytime that there's just a even glimmer that they're not going to lower, or some sort of jobs report comes out, CPI comes in hot, PCE comes in hot, and we've seen that recently. The stock has performed abysmally, even worse than many of its peers that are in a similar stage in their company. And so I think that that's a lot of it. Is this narrative is tied up into that? And I'm not saying all the shorts are idiots. No, they're smart, and they know that narratives oftentimes can push a stock in directions temporarily. And so they're taking full advantage of it right now. Congratulations, making money. But if I was somebody that was on the sidelines up to this point, and I looked at the company and I said, hey, it's $7 and some change, I would be scared to touch it as a short. Even if we're on the opposite end, if SoFi was trading at like $22, be like, well, yeah, they're executing well, but man, I'm going to wait to buy. It's dangerous to buy at that level.
Yeah. No, I mean, it can only fall so far. It's free for me to hold on to shares. It's not free for them to hold on to their shorts. So who knows? Who knows? But it really, everyone keeps like keeping a hold of this data. But really, I just find it is actually more sort of gunpowder on the side of a potential reversal. Because right now it's a lot of just retail traders. But we saw in the last quarter, whenever we saw institutional trades, you started seeing like Jim Simmons, Paul Tudor Jones, a couple of these people who are trying to find opportunities starting to buy in. Even if Wall Street right now is shorting this company, if Wall Street gets a sniff, because Wall Street's not a big conglomerate, it's many different players and they're all versus each other. If a part of them gets a sniff that there could be a short squeeze in here, I promise you they'll participate on the upside as well. So who knows?
Well, I think for me, I'm like running out of justifications to try to steelman the short case. Throughout time, it's been, okay, well, we might go into a hard landing situation, therefore people are shorting, it makes sense. So if I might have high defaults, it makes sense for shorts. And then I said, okay, well, probably not going to go into a hard landing, but SoFi is still not profitable. It's, the execution risk. It makes sense. And then I even saw this argument this week to say that, well, obviously Bank of America and a lot like Goldman and these institutions knew that that May was coming up to renew their 12.5% preferred shares. And so they would be shorting going into that event because they know that that's going to bring the stock down when they issue the convertible notes. Even Anthony Notto mentioned that on Kramer in passing. And so it makes sense. But like I'm running out of reasons. I even had a justification to say, okay, well, shorts want to keep it low so that they can keep buying more shares. And yet we've been trading in this channel for so long that right now going into Q1, and as we expect profitability, over the next, a month away from earnings, I'm running out of reasons and the short interest keeps rising. And the more that happens, it just confuses me even more because I can't make a case for it anymore. Whereas over the past 2 years, I could feasibly make a case as to say, for all of these reasons at different points in time, yeah, I understand how someone would be short.
Yeah, I mean, there was the delta hedging, I think, which does play a little bit of a factor for the convertible notes that just happened. So there might be an influx of just, people hedging their bets, but who knows? Who knows? It really doesn't get to me. I just want to make sure that the numbers that SoFi is actually putting out are the numbers that we're expecting or better, right? It'll be interesting whenever the new quarter comes up to see how their marketing efforts with the NBA has been playing out. if people are actually signing up for new products or if they're just like downloading it just to get entry into a $10,000 thing and then not using any of the products. So those are the sort of things that I still want to keep track of: average revenue per user, contribution profits per segment. You know, the margins are the important part of the business. If those continue to go up, especially in Q1, I'm very confident.
Yeah,
I wanted to highlight. Sorry.
and I view this as a gift. Honestly, I had not planned to. I planned to add a little bit to SoFi this year, but not considerably. But just because of the price action, I've bought, was it 8 weeks in a row or 9 weeks in a row? I've lost count now, and they're not small buys. I plan to make Tesla my number one buy target. I've bought more SoFi than Tesla at the start of this year. Long term, it's fine. I can hold on those shares forever. The only way it impacts me is, am I going to take advantage of this gift? If I thought the thesis had changed, I wouldn't be buying. But it's the same company that was at like $10 and some change at the end of the year, and I was like, hey, I think it's a little bit undervalued here. It's $7. It dipped down under 7. I'm like, thank you. Nothing has changed. It has impacted me as far as being able to sell covered calls. I could still do that. I just think that just like if I was shorting the company, which I'm not, that there's some risk on the upside, just blowing things out. I see that with covered calls as well. So the little tiny premiums that I get for covered calls, I'm not even touching it right now. I'm just saying, forget it. We'll wait till we're up higher. It's not worth the risk that I get my shares exercised at a price that I think is undervalued for SoFi.
I mean, I recently saw, who was it? Oh, Michael Perito. That's who it was. They did the $6.50 price target on SoFi a little bit ago. And the main reason was that interest rates cutting is going to actually lower the coupon rates of the personal loans, and SoFi is going to end up making less interest income. And now that rates are staying for longer, people are like, well, SoFi is going to, have a hard time continuing to sell their student loans. And, it's not good for banks in a lowering interest rate environment. It's like, guys, come on. Can we talk about just going with whichever way the wind blows? I mean, come on.
Supports their argument. It's like, hey, I want the conclusion to be I am short. Find some convoluted path to conclude there. I mean, you said it yourself a couple of days ago, right? Bears sound smart, bulls make money. Was that what you said?
Yeah.
There you go. Like, SoFi was successful in the low rate.
Not my quote, by the way, but
yeah, they were successful in the low rate environment. They were also successful in the high rate environment, different segments of their business, guys. Now it's like you can't have your cake and eat it too. Oh, well, if it's a low rate environment, you could just as easily make the argument that they're going to be successful as you can that they're going to be not successful, and vice versa for if we're in a higher rate environment. So, take your pick a lane.
They won't, though. That's where there are different types of bears. Some that will key on it just for this, and some that. But most are just being disingenuous, and they're picking, no matter what the narrative is, because it's a diversified business. Some segments will perform well in high interest, and some will perform well in low interest, and so they can always pick something. And so that's when, at least from my perspective, when I encounter people that are basically like, "Hey, no matter what, I'm going to find this little piece of data for confirmation bias," I just say, you know what? It's not worth my time. If you want to short the company, please short it. I encourage you to do that. Double down, triple down. Use Alex Karp's line about, the cocaine dealers and all that stuff. I don't care. Jump on it and make it 30, 40%. Send it down to $4. If it's the exact same company as we have right now, I would love SoFi at $4. It's going to not be fun buying it. You got the stomach going on and the butterflies and the nerves. And what if I'm wrong? Then you look at the company, you're like, oh yeah, this is SoFi. And at least for me, I'll just be buying all the way down and all the way back up. It's temporary.
Well, just to pivot us, Roy, since I know we're at 54 minutes here, what was the first, couple of questions that Kramer asked? Why is the stock at $7? What are you doing for the stock price? This is what investors would say. Your stock should be trading at $10. I get people calling me all the time. Why are we so low? Like, for better or for worse, I do think that his questions represented a level of basic knowledge that, in my mind, is emblematic of the average retail investor.
On
right?
purpose.
on purpose. Yeah, he's
Yeah.
trying to represent. He's trying to channel that retail investor. You know,
Softballs.
is this good or bad? Is the stock going up or down? Why is this stock not going up? And Anthony Noto was like, dude, it's good for our business. We make money. We saw an opportunity. We did it from a position of strength. And then Kramer, towards the end of the interview, was like, okay, that all makes sense. But like, why is the stock still low? Like, what are you going to do? And it was just, you could see them at a disconnect there because Anthony Noto just cares about the business and Kramer cares about the stock.
Yeah, I mean, I think it's hard for Anthony as a, you know, CEO of a regulated bank now to pump stock or something like this. So, you know, he's coming out and talking product. You see that from the big other big bank CEOs. So I don't think he can come on and do what Alex Karp does. They're in different arenas, you know. So,
And he shouldn't. But
yeah,
it just, I think that it's a very retail focused show for Kramer, and he actually lobbed a lot of softballs. I think he loves, or at least really likes and respects Noto, and so wanted to bring him on the show to help SoFi as a business, to give him a platform to clarify, and lob just a lot of softballs, and Noto did well with it.
Dude, yeah, I mean, one of the people in my chat said, I mean, it's Jim Cramer. What do you expect? To which I would respond, there's no legitimate interview that you can have in 6 minutes. And that's the duration of that entire segment. It's like, get three good sound bites. If you can get 3 good sound bites, it's a win, man. You know, pack it up.
You can understand that when you listen to how fast Noto is talking. Like, he completely understands, and he's just trying to bang through it before it's on to the next clip. So yeah, I didn't have a problem with the Jim Cramer questions at all. He answered the most topical thing that's in the news right now, and it was the most confusing part of SoFi in the last little bit. And Anthony Noto tried to help clarify some questions that this is not, necessarily bad. Yes, there will be some negligible amount of dilution, but dilution is not the only thing. If it's going to help you actually make more money, then you end up diluting. So yeah.
Can we spend 30 seconds talking about the 60 million? Because I thought that was the most interesting part. Yeah, he talked about the capital ratios and how that's great. And he talked about how it was a negligible.
That's super, super important, though. I wouldn't brush past that at just like that was my biggest bear case, was that if the cap ratios get too low, we were at 14.5%. Like, everyone was calling me a bear during that time. Now he's saying we'd be at 17.3%. That is massively different.
1,000%. I totally agree with you. The reason I'm brushing over it is because we already had that like in writing in the release.
Sure.
The 60 million was not so evident because we were all looking at the 12.5% preferred shares that they were getting rid of. And that was about 40 million.
Mm-hmm.
And then he said there's another 500 million of outstanding debt that would result in up to 60 million in savings down to the bottom line. Well, hell, 60 million is what, 5 cents EPS, something like that. Like, that's almost the entirety of what analysts were expecting SoFi to come in for full year revenue. So not exactly, but almost.
I think that I think people are getting a little confused. I don't think that the EPS is going to be changing too much because they are diluting. But I think that the amount that they're adding on versus the amount that they're diluting is making it almost flat. And so, yeah, I don't think that we're going to see a full year beat just based on this. I mean, the stock would change drastically.
It's going to be interesting to see what they come in at Q1 for EPS, because that's going to set the tone for what the rest of the year is going to be. You can't have an analyst in their right mind, aside from maybe David Cavarini and whatever his face Bologna, who have 5 cent EPS price targets for the year if SoFi comes in at 3 cents EPS for Q1. Like, they just look like freaking idiots out there.
Yeah, I believe it's pronounced Bologna.
Yeah.
Bologna. I want to show a chart off really quick. This is from Growth to Value. He's been on the channel twice, actually. I think he's unbelievably smart. No one ever watches our videos because we talk about obscure stocks. Like, he came on and was talking about Adyen, and that video got no love. And he's one of the best growth investors, in my opinion. But anyway, Chris talked about this, showed up this this chart. Where in SoFi's, lifespan would you place SoFi on this chart? I think it's pretty clear. Probably in high growth, that going from loss to profit. This was not trying to bring it back to this, but this is the hard thing that whenever you're talking about value investors or people that are valuing this like a bank versus others, is it's very hard to talk whenever they're focused on this loss portion right here, saying we are a losing company, when we're out of that stage now. We're about right here in the business, and it's hard to project this whenever people just don't believe that. Growth investors want to focus on this part of the business. Value investors are focused on this part of the business.
Can you email this chart to Gary or like fax it to him?
I've seen this. I've seen this in similar places too, where price to earnings, that's a good metric, or even the PEG ratio. When there's not earnings, or when they're profitable for a quarter or two, like, what are you doing? That's not the right metric. This shows it very well. I think actually better than the other one that I'm kind of familiar with. But you can get stuck on one valuation measure. By the way, it says there price free cash flow in the next stage. If people are valuing SoFi as a bank with price to free cash flow, they don't know how banks work. I know that Gary was not doing that, but it just, you got to look at it from all different angles, do your due diligence, make sure you know what you're buying. And that way, if the stock price drops and the company's the same, you're like, this is on sell, versus if you don't know the company well, the stock price drops, you're like, well, maybe I got it wrong. Maybe I should sell too.
Do you guys want to jump over into the SoFi Weekly After Hours show? I want to talk about some fun new innovations.
Palantir, sure, let's do it.
Maybe Palantir. Yeah, I want to hear about what you said pre-show, so you can tell me more about that. I was going to talk a little bit about it.
Dude, hold on. Can we talk about one last thing before we jump on? Notto responded to Chris Hager earlier today or last night about a potential little tease on a tax product. I thought that was really interesting. Remember, a tax product was on my list of predictions for this year. I don't know if it's going to come because they still haven't rolled out Zelle, but if it does come, ooh, baby, that's going to be good, because that really contributes to that ecosystem benefit that users get. They have Relay, they have checking and savings. If they have a nice little tax product, then you can siphon people off of TurboTax and others, and they can really have more use cases for SoFi in-house.
I don't know how tax season works in the States. I really have no clue. For Canada, it's right now.
Yeah.
So, I mean, are they rolling it out this year? I don't know. This seems like a next season kind of thing.
It would, if they roll it out, like, it wouldn't be bad to roll it out November, December. Just, that way, it. You have all the documents there, and you can think about that when you get your documents in early January. But yeah, mid-April, April 17th, it's coming up. So if you're in the States, you haven't done your taxes, do that. I thought that was a potato, by the way. We potato you. I had to because it was sent to me as like a screenshot, and it's really small. I'm like, what in the world? And I love potatoes. Don't get me wrong, but that's one thing I love about the company is that they do hear us. They do listen to our requests. They change things that are appropriate. I love that, and I value that.
Have you guys ever watched Succession? Because that's what I thought about it. The slogan, "We hear you. We hear for you." No?
No. Sorry.
I'll show you the YouTube clip afterwards.
Okay.
Anyways.
We hear you? What is that? Oh, Lurker, man. That's got to be some sort of IQ test or something.
I wouldn't be surprised if analysts come out with that kind of shit afterwards. Anthony Notto, we hear you? Like, sell rating.
Yeah. All right, let's go. I want to do the SoFi Weekly After Hours. It's going to be extra long, extra fun. There's going to be a lot more viewers this time than last time.
I saw that. 150 memberships. Pretty good.
Jeez.
Somebody gifted you 150 members. That's wild to me, considering the fact that I think members on my account are like 15.
Thank you.
So
appreciate
15 more than I have, buddy.
Yeah.
Those 15 have equal access than Tanner's 150, so they're as good as gold, baby.
Yeah. Yeah. No, it's true. All right. See you guys over there. And that's tomorrow at noon, by the way. For the members, it doesn't come out live right now. It's tomorrow. So for all the new members that are watching, you got to wait your turn. Okay.
And if you're not a member, how does
Do it.
one become a member, Tanner?
It's just right down below, Tevis, right beside the subscribe button, which is already pressed. It will, instead of saying subscribe, it's going to say subscribed. And then, so then there's a join button right beside that. Now, this isn't free. This is for, very, very good boys that have lots and lots of money. So if you have $5, you can subscribe to either Tevis or myself. You hear that? That's only $5. You can put real bricks behind these walls with your money to support creators who want to do YouTube instead of their real jobs. So you can click that down below, or it's in the description down below. Thank you guys so much for watching. Bye for now.
You sound like the ShamWow guy.
I was going for it.
Yeah.